Welcome, everyone. A special shout out to all of you preparing for competitive exams. Today, we are going to break down the incredible evolution of India's banking regulations. It's really a story of transformation, moving from a period of stress to one of real strength, and we'll also peek at what's coming next. So, let's dive right in. So here's our game plan. We'll kick things off with RBI's core philosophy, what really drives them. Then we'll take a trip back through the last 10 years to see the critical reforms that changed everything. After that, we'll get into the new rulebooks being proposed, understand the RBI's guiding principles, and then we'll wrap it all up with the key takeaways you'll definitely want for your exams. Okay, first up. What's the one big idea that drives every single decision the RBI makes? Honestly, if you get this, everything else that follows will make perfect sense. This quote right here is the absolute key. You have to understand the RBI's mindset. Every policy, every single rule is built on the solid bedrock of financial stability. It is their ultimate goal, their guiding North Star. It's all about making sure we have long-term, sustainable growth, even if it means sacrificing some short-term gains. Now, this is a piece of jargon you absolutely need to know for your exams. Responsive conservatism. It might sound a bit academic, but it perfectly captures the RBI's whole approach. It's about being conservative, playing it safe to protect the system, but also being responsive and open to new ideas, innovation, and reform. Think of it as balancing safety with progress. So, next up, let's actually see this philosophy in action. We're going to trace the journey of Indian banking over the last decade, and it's a pretty remarkable story of facing a huge crisis head-on and coming out so much stronger on the other side. So, a decade ago, this was the heart of the problem, the twin balance sheet problem. It created this really nasty, vicious cycle where companies had way too much debt and couldn't pay their loans, which in turn put massive stress on the banks. This weakness is what led to India being labeled one of the fragile 5 economies back then. So, how did they fix it? Well, it wasn't a simple band-aid. It was more like a foundational surgery. This timeline shows you the order of events. It all started in 2015 with the Asset Quality Review, or AQR, which basically forced everyone to admit how bad the problem was. Then came the game-changing IBC in 2016, followed by the big consolidation of public sector banks to create fewer but much stronger institutions. Here's a great little mnemonic to help you remember this whole process for your exams. Just think of the 3 R's of banking revival. The first R is recognition, admitting the problem with the AQR. The second R is resolution, creating a path to fix the bad loans with the IBC. And the third R is recapitalization, pumping fresh capital back into the banks to make them strong again. So, did all that work? Well, the numbers on this slide speak for themselves. The results are just staggering. I mean, look at that improvement in asset quality. Gross non-performing assets have collapsed from a peak of over 11% down to just 2.3%. That is a huge, huge turnaround. And this chart really shows you how much stronger our banks have become. The capital to risk-weighted assets ratio, CRAR for short, has jumped up significantly. It's way above the minimum required. This buffer, this extra capital, is what makes them resilient to any future shocks. So here's the crucial point. It's not just that banks are safer, they're also way more profitable now. Going from a negative return on assets to a healthy positive one means they are in a great position to lend money and really support the country's economic growth. Okay, so the system is back on solid ground, but the RBI isn't just standing still. Now it's evolving its rules for what's become a much more mature financial system. So let's look at some of the key changes being proposed that really reflect this new reality. Before we jump into the details of external borrowings, it's really important to get the context right. India's external position is incredibly strong, and it's anchored by these massive forex reserves. We're talking around $700 billion. That strength provides a huge safety net for any reforms. So what's happening with external commercial borrowing, or ECB norms? Well, the proposed changes are all about giving companies more flexibility to borrow from overseas at better rates. But, and this is key, notice the guardrails. Limits are linked to a company's financial strength, and there's an overall cap relative to GDP. Safety is never compromised. The rules for lending against things like shares and bonds are getting an update too. The key thing to see here is the smart distinction being made between debt and equity. Limits are being eased for safer, high-quality debt, but they're being kept for the more volatile world of equities. It's a really nuanced, risk-based approach. Now, this is a pretty big deal. The RBI is basically proposing to replace an old, rigid framework with something much more dynamic. It's really a vote of confidence in the banks. The message is clear. The system is mature enough now to move away from one-size-fits-all rules and towards more sophisticated risk management at the individual bank level. You see, these individual changes aren't just random tweaks here and there. They're all part of a larger, coherent philosophy. Let's explore the RBI's role as a guide, a sort of guiding hand for the entire financial system. This Gardner analogy is such a powerful way to understand the RBI's role, and it's a great concept for your exams. A gardener doesn't just plant seeds and walk away, right? Their job is to nurture growth, but also to actively monitor and prune away any weeds or unwanted growth to make sure the whole garden stays healthy and beautiful. And this is so crucial to remember. These rules don't exist in a vacuum. They all work together, like different layers of a defense system. If you only look at one rule change without seeing how it fits into the whole system, you risk missing the big picture. Missing the forest for the trees. All right, let's pull all of this together into a nice, clean summary for your notes. This is the really crucial information you want to make sure you lock in for your exams. Okay, let's memorize these core concepts. The guiding philosophy is always financial stability. That's the North Star. The approach is responsive conservatism. The big problem of the past was the twin balance sheet problem, and the fix was that easy-to-remember mnemonic, the 3 Rs: recognition, resolution, and recapitalization. And of course, don't forget that Gardner analogy to describe the RBI's role. These concepts explain the why behind everything we've talked about. And these numbers, these provide the hard evidence of the transformation. Make sure you note these specific data points: the dramatic fall in NPAs, the big rise in the CAR and the ROA, plus this key figures for Forex reserves and the ECB ceiling. This is exactly the kind of data that loves to pop up in exams. So we've seen the journey so far, a really incredible story of recovery and reform. But the path ahead is just as important. And this question leaves us thinking about the next chapter in India's financial story. It's that constant balancing act, isn't it? Fueling growth while always guarding against risk. Thank you so much for joining this explainer.